Hi, I'm Grace, and you're listening to Bread and Honey, the money podcast where we learn, educate, and chat about everything and anything related to your personal finances, brought to you by our friends at Marble. Today, and for every episode, you'll be joined by Patricia, who is a resident financial guru, author, and credit expert, alongside myself, to discuss all your need-to-knows and essentials for your exciting financial journey. Each episode, we will discuss topics from credit scores, budgeting, savings, and more, with inspiring and influential people who know the personal finance industry inside out. We're on a mission to empower Canadians to a great financial future, and for this podcast, we want to join you on this journey. So welcome to episode 1 of Bread and Honey. For our very first episode, we're joined by Edward Jamison, a credit attorney and author. Today we're going to be talking about credit score myths and try debunking them with the help of both Patricia and Edward. I think we're in very good hands here. But firstly, I just wanted to welcome Patricia to the show, who I mentioned is our financial guru. So Patricia has 20 plus years experience in the financial sector. She's won several awards, written books, an inspiring entrepreneur, and among all, you're also a mom and a grandmother. So Patricia, tell us a little bit about what led you to work in this industry.
Sure. First, I'd like to introduce myself. My name is Patricia Giancas, and I'm presently working with Marble Financial in the role of a VP Strategic Partnership. I've worked in the industry for several years, over 39 years actually, of which 20 of those years as a mortgage broker owner of Centum Metrocap Wealth Solutions. I started my career many moons ago, working as a payable clerk, didn't like it, moved into banking, and I worked my way up the ladder, becoming a manager. But I really actually found my passion when I started to work for a finance company. That company is in Canada and the US, Beneficial Finance. And I learned a lot. We were able to help those clients that the banks declined for a loan or a mortgage. And although the rates were a little bit higher, the fact that we were able to help those underbanked clients were amazing. I had the opportunity to help these clients to increase their credit scores, although in those days, they didn't have such a thing as credit scores. We used to manually tally up information based on the clients. For instance, if the clients are single, married, they have kids, all of that had points. And so we use a point system that we manually add up for the clients to see if they qualify for a loan or mortgage. The reasoning behind those calculations in those days are similar or same as to the ones we have now. And so we spent a lot of time, if they didn't qualify, what are the things they need to do? We didn't tell them you need to go get married so you can get some extra points, but we worked with these clients to help them get out of debt. And then I found Marble. Marble is the company that I fell in love with. They have a unique software. They have the score up system that had been in development for many years, and it has millions of pieces of algorithms embedded in its system. And it's actually one of the best systems as far as I know, in the industry. Marble and their staff has been exceptional in working in developing end-to-end solutions with clients' well-being in mind.
Yeah, no, Marble really has an amazing product. So today we want to start off with one of our favourite topics, which is credit scores. So alongside our resident guru, Patricia, today, I'd like to welcome our very first guest to Bread and Honey. So Edward, I just want to welcome you to the show. We're so pleased to have you. I'm really excited to have you here for our very first podcast. So welcome.
My pleasure. Thanks for having me.
No problem. So both Patricia and I are aware of your amazing background in this sector. So just for listeners who may not be as familiar, tell us a bit about yourself and how did you get started in this industry?
Okay, well, back in 2000, I just graduated law school a year prior, and I moved to Los Angeles. I didn't really want to be an attorney at the time. I was still unsure with what I wanted to do with my life, so I decided I was going to move to Los Angeles to be an actor. What else could I do, right? But I couldn't. But the problem was I couldn't act to save my life. I got a lot of first first auditions, but I never got called back. I looked like a fish out of water, and I knew it. I felt really uncomfortable doing it, but at least I kicked it off my bucket list of things I wanted to try. But I liked Los Angeles. At the time, Los Angeles was great. It wasn't as bad as it is right now with all the natural disasters and everything else going on. But it's so I decided, hey, I want to stay here. What can I do? I need to do something. So I said, well, I'm going to take the bar first. So I started studying for the bar. And I had a friend that was a mortgage broker, and he was telling me about this lady that helped one of his clients get approved because she got some negatives removed from the client's credit report. I'm like, oh, wow, you could do that. And then so he ended up introducing me to her, and I ended up getting a job with her part-time while I was studying for the bar, and started getting very engulfed in the credit industry and started like wanting to know what's a credit score? What's it do? How do you get things removed from the credit report? What are the laws pertaining to that? And once I passed the bar in California, I said, okay, well, I'm just going to be a credit attorney. So, and that's when I set up my first firm, which was Jamison Law Group at the time. And we mainly focused on, we did bankruptcies, we did a lot of credit repair and a lot of debt settlement, but it was, that's how I got in the industry initially.
Okay, geez, that's very exciting. Actor turn attorney, very exciting.
Yeah.
So what basically led you to do the exact work you do at the moment?
Well, I didn't fall into credit by accident in the sense that whenever he said this lady was able to get things removed, I already was intrigued by the credit industry because I had a pizza shop. Like my third year of college for undergrad, I opened a pizza shop up. And when I opened the pizza shop up, I had a $500 Citibank card that I got in college that I was able to just keep asking for credit line increases. And I got it up to like $10,000 for the credit limit. And I had I forget what the other two cards were, but I had a couple other cards for like $4,000 each. And the day I opened my pizza shop up, I literally was maxed out on all three credit cards. I owed like $17,950. Like I couldn't even take an extra $100 out. And I opened the pizza shop up that day. Thank God it was a success, and I was able to pay everything else off like pretty quickly. But I knew early on that credit was very important. There's no way I could have been able to open my business or get ahead the way that I did if I didn't have credit. So I was always intrigued by like, okay, what can you do to be able to get more credit? How can you increase credit limits and do things like that? So that's what initially whetted my appetite for the credit business.
Geez, yeah. So from there, basically, you got your love for credit, and you really became an expert in it. You've written books on credit scores. Can you tell us a little bit more about them?
Yeah, I wrote the first book I wrote on credit was called Even the Score, which I wrote back in 2009, and that basically goes through and tells people it explains credit scoring, and it also explains how to clean one's credit up, how to settle debts, how to settle collections for deletions, like all the tricks of the trade that you want to know how to do whenever you're trying to get your credit cleaned up. And then the second book that I wrote was called, I co-authored it actually. And Darren Aronow is a fellow attorney and a friend. We wrote a book together called Credit Where Credit Is Due that talks about how you can actually sue the credit bureaus and the creditors for mistakes that are on the credit report.
It's amazing. And so from there, why do you feel then credit scores are so important?
Well, credit scores, I mean, they're used for more than just getting credit. I mean, they're used to decide whether or not to rent to people. They're used, obviously, for getting a car, getting a mortgage, or getting credit cards. But even when people are getting hired, a lot of the times they check their credit because people that have bad credit are more likely to pilfer things. So like if they'd rather hire somebody with good credit than somebody with bad credit. And also for getting insurance, even auto insurance, they find people that have good credit tend to be more responsible overall and tend to have less accidents as far as carelessness goes. So it's credit covers the gambit. Whatever you're trying to do in life, it seems like your credit or your credit score can be involved in a lot of ways. And even nowadays, they even have dating sites where people are disclose, they ask you what your credit score is. It's like one of the questions.
Oh, no way. That's crazy.
I forget the name of the site, but I saw it on an article once and I was like, wow. It's like, but I mean, if you think about it, it's like, why not, right?
Yeah, exactly. They're like bad credit score, no future together. So
yeah.
That is funny.
Yeah, that's pretty cool. Yeah, so basically we know credit scores are important to a lot of people for many different aspects of their life. But when it does come to credit scores, there's lots of rumors floating around. So we hear myths from families, friends who basically warn us against taking part in certain credit score practices in the fear that will damage our credit score. Credit is confusing enough already. So I definitely think it's best to get to the bottom of these myths and rumors. So firstly, Patricia and Edward, I know you know everything and pretty much everything about credit scores. So I think we're in great hands here to try debunk some of these credit score myths. So let's go to the first one. So the first myth that I have is asking for your credit score hurts it. So the first thing I just want to draw attention to is that we actually recently conducted a survey with Marble, and we discovered that there was 64% of respondents of our survey, they were afraid to check their credit score. Now, so this could be for a number of reasons. They could be afraid of a bad credit score. They're using that sort of out of sight, out of mind tactic, which we all know is not beneficial. So firstly, Edward, we can go to yourself. Do you feel this is true, that asking for your credit score hurts it?
Well, it depends. I mean, if you ask for your credit score, like on Experian.com, Equifax.com, freecreditscore.com, annualcreditreport.com, like those personal consumer websites, they don't hurt your credit score. That's considered a personal inquiry. But if you ask for your credit score, like let's say you have a credit card and you call the credit card company, you say, I have a $10,000 limit. Can you give me a $15,000 limit? Can you raise my limit? That's the type of inquiry where they're pulling your credit because you're asking for more credit, so that would hurt you. But if you have a situation where that same credit card company, let's say it's Citibank, like you don't ask Citibank for anything, but Citibank like once a year decides to pull your credit just to make sure you're not going off the deep end, that's considered an account review inquiry. And that doesn't hurt your credit score because you did not initiate asking for more credit. That was just the credit card company doing their due diligence, making sure they still considered you a viable risk to be lending money to. And then the other, and there's also the promotional inquiry. The promotional inquiry are those credit card offers you get in the mail. Those do not hurt your credit. They only hurt your credit if you actually take the offer and apply for credit. If you say, okay, Citibank, I'd like this 0% card. And keep in mind that promotional credit card offer doesn't mean you're approved automatically. It just means that you fell within the criteria that they were looking for, like somebody that was living in a single family home in a certain area where a certain average income or whatever. It doesn't mean you're approved automatically. It just means you're likely to get approved. But once you do accept that offer, you're really accepting the fact that you want them to consider your application. It's not a guarantee. But once you actually send that in, they do pull a full credit report on you. And that would be an inquiry that would hurt your credit. And then obviously when you apply for new credit cards or when you apply to go get a car loan or a home loan, those also hurt your credit. But keep in mind, auto loans and mortgages, whenever you're shopping for a car or getting a mortgage, all of the inquiries made within a 45-day period are only treated as one. So if you go to 10 different dealerships in a 2-week period and have every single one of them pull your credit, it's only going to hurt your credit as though it was one inquiry. So it will hurt it, but it's not going to hurt it 10 times. It's going to hurt it basically once in the grand scheme of things. Same with mortgages. But credit cards, every single credit card you apply for is going to hurt you. It's like a punch in the face every time. So if you apply for 10 credit cards, you have 10 times that your credit score is going to get dinged.
Oh, okay. Geez, I didn't know that. Like every credit card you apply for then. So that would be considered a hard pull inquiry. Would that be?
Yes.
Right
Yeah, all these are hard pulls. Yeah.
Okay. Yeah. And Patricia, what's your stance then on this?
Bob, everything that Edward said is the same in Canada, except for mortgages. It's instead of 45 days, it's 60 days. So you can shop around for, yes, that I believe just got changed actually. And a lot of people don't realize it. But having said that, if the clients are shopping around from broker to broker, from bank to bank, that doesn't show well on your stability and on yourself, on your credit reputation risk. You're just credit shopping. And so for myself, I mean, back in the days, we were scared to go to pull our credit. We don't know what it would look like. Should we do it? Should we not do it? Because we don't have enough the right tools or educational tools out there to assist us in how to understand credit. when we should obtain credit, why should we obtain credit, all of these other things. And so as a result, with Marble hoping that another companies having educational tools to assist clients would take that fear away of reputational risk, credit reputational risk. And I believe that the sooner the clients start taking that plunge to get their report, understand their report, the faster they can start working on challenges that may arise, and they can work on these challenges for better end results.
Yeah, Patricia, I'm glad you brought that up because you reminded me to make a quick clarification. You have a lot more experience than I do in the underwriting department and actually like looking at factors outside of the credit score. So something like when I said, oh, if you have like 10 inquiries, that doesn't hurt your credit. I'm speaking strictly credit score related. So if you have an underwriter that has to manually underwrite the loan, they may look at Jane and John have the same exact score, same exact income, same exact everything. But for whatever reason, for personal choice, they might say, yeah, but why is John looking at so many places? This guy, even though he has the same score as Jane, I don't know. He looks like he's like desperate. They might have some type of bias in their head, and they might, when they're manually underwriting, might just say, okay, well, I'm going to kick this out. So I want to make sure that people don't get confused on that. I'm speaking strictly credit scoring, like where a robot program is making a decision. Yes. Where there's other things that Patricia may speak on that go outside of that. So I just want to make sure people are paying attention to that. Good point.
Thank you.
Perfect. Thanks for the clarification. No, that's great. No, I think we've definitely debunked that myth for sure. So for myth 2, we have closing credit cards help improve your credit health. So firstly, I can get why people may feel this way about this one. It can obviously work as I said before, the out of sight, out of mind tactic, which basically, we won't spend on a credit card we don't have. But I don't think, for example, that this myth generally works with us. It may work against us. Guys, what do you think about this one? Is it a bad move to make?
I think closing a credit card is definitely a no-no. Every time you touch your credit score, whether you're closing an account or you're adding an account, you lose points. And you only recover points if you're adding an account by making monthly payments. So if you're closing a long credit history account, or the credit card limit to assist with credit utilization, because credit utilization takes up 35% of your credit file, which is approximately 315 points. So always remember, every time you touch your credit report, you lose points. Right, Edward?
Yes, that's correct. And I'll give you the reasoning behind this. The credit score is all the credit score is trying to predict is whether or not you're going to become 90 days late or more over the next 2 years. It's not trying to, they have different scores for different things. They have the bankruptcy score, the auto industry option. But as far as like getting a mortgage or getting a credit card, and they have credit card specific credit scores also that try to predict whether or not you'll be late on a credit card. But whenever it's trying to predict whether you're going to become 90 days late or more, there's a few things that happen. I guess I'm going to explain how the credit score is made. I think I'll try to do it quickly and in a very easy fashion because it ties everything in. But the way they made the credit scores, they got like, let's say 1 million credit reports, and so different models have different numbers they use. They took those 1 million credit reports and they said, okay, here's these 1 million people. I'm pulling their credit today. Then they said 2 years later, they said, okay, those same 1 million people, I'm pulling their credit again. And I'm going to see which ones went 90 days late and over the past 2 years. So all the people, let's say 200,000 of them went 90 days late or more. They take those 200,000, they separate them from the 800,000 that didn't. And they say, okay, what did these people that went 90 days late or more have in common? So if somebody closes a credit card, the reason it's bad is because one of the big factors, the second biggest factor in making your credit score is your revolving debt utilization. So if you're using 0% of your credit card, let's say you have $50,000 in available credit, or no, let's say you're using 10%. You have $50,000 in available credit, and you have $5,000 you owe. You're 10% utilized. So that's, if you have one credit card for 25 grand that you owe 0 on, and you close that credit card, now that $5,000 is 20% utilization of the total of 25,000 you have for credit cards. So you took your credit utilization and made it go from 10% all the way up to 20% just by closing one of those credit cards. That's why it's a no-no to ever close a credit card, because you're taking away the credit you have available. Now, you might say, well, why is that bad? Like, why is utilization so important? Well, just think about it. If you're going to go, who's more likely to go 90 days late? Let's say let's say Patricia and I are the same. We have the same credit. We have the same everything. She has the $50,000 in credit. I have the $25,000. I have the $25,000 because I closed one of my credit cards. Over the next 2 years, let's say a pandemic hits. We all know that word right now. And both of us lose our jobs. Who is more likely to keep being able to pool money to live before going 90 days late? Me or Patricia? Well, Patricia, because she has more credit available and she can keep pulling from her credit cards. So therefore, she is going to be less of a risk than I am because I'm higher utilized in the credit that I have available. Does that make sense?
Yeah, no, that makes sense. Yeah. So Patricia, the debt ratio. So that's the main kind of thing to learn, your credit utilization rate. Would that be the same sort of thing?
Yes.
Okay.
Yeah, and let me add one more thing. Another reason it hurts you by closing the credit card is the average age of the credit file, which is 15% of the credit score. If you have a 20-year-old credit card and you close it, that credit card's not going to turn 21, 22, 23 in the future, and the average age of your file is going to be less than it would be had you left the credit card open. So never close a credit card. Just leave it open and don't use it, but never close it.
Okay, so that goes down to say having a longer credit history is better, I suppose, in a way.
Yes.
A longer good credit history, I assume. Yeah.
Yeah, and the reason being is because they've looked, the people that were in that 200,000 of the pay 90 days later more of them had younger credit histories than the people that didn't go 90 days late. Therefore, that's a factor in predicting whether or not somebody's going to go 90 days late in the future. It all comes down, you can basically understand credit scoring if you just think with logic. Like, okay, which person with these characteristics would I assume is going to go 90 days later more? And usually you can figure it out with logic if you look at the variables.
Well, also, Edward, if the client has only one credit card, that also that's 10% of types of credits in use.
Yeah, correct.
Right?
Yeah, you have a mix of credits, 10%.
Yes, right.
I say 2 or 3 credit cards is the ultimate, but I used to have 20 credit cards and I still had a 790 credit score. So it's something where, but then again, it's only 10%. But if you really want to get the best score you could possibly ever have in a million years, different people disagree on this. Some people say, I have 2. Some people say 3. Some people say 4. But I'd say have about 3 credit cards if you really want to splice hairs together and try to get the highest score possible. But for me, I'd rather say if you can have more credit cards, have it, because you never know when you're going to need the credit. And having more credit cards you can pull from can prevent you from paying late. If ever you have a downturn in your life with your career or something else, you can actually use your credit to get through the tough spots.
So say, for example, like myself, I've only moved to Canada in November. I haven't still got a credit card yet here. I probably should. But what would you recommend, for example, for someone? So I have no credit score and I've no credit card. Where do you think I should go from here to both Patricia and Edward? And what should I do next? And what would you recommend for other people who are listening who might be in the same boat? They mightn't have a credit score. They might be younger who maybe have never obtained one yet, or they might be new to the country like myself. What would you recommend?
I can take that. I think, Grace, you need to have a credit score mix. So you need to have a loan, a small loan, if you wish, with monthly payments, but try to get 2 or 3 credit cards, as Edward said. And if they're not giving it to you, get secured credit cards. The banks in Toronto give you, or in Canada, give you a secured credit card. So you don't have to go to the subprime lenders to get it. And once you get it, then we teach you how to use it.
Okay, sounds good. Edward, would you agree then? Just basically, I just need to have a credit mix and get myself a credit card really and get started as soon as possible. Yes.
Ideally, I'll give you an example. I had a car lease, and I paid my lease. It was a 40-month lease, and I just paid the last payment last month. As soon as I paid the last payment, that was my mix. That was one of my installment accounts. My credit score dropped 17 points. Even though one would think, wow, wouldn't it be better like you actually paid off your lease or whatever? It doesn't matter. The credit score likes to see a mix because they calculated this based on a million different people. So yes, that is correct.
That's good to know as well.
Yes.
Okay, so on to the next myth. So next one is higher pay brings higher credit scores. So this would probably be extremely unfair if it was the case. Like, of course, I do know your credit score is about how well you pay your bills and how reliable you are. You could have a lot of money and also be bad at paying off your credit bills. So why does a higher pay not increase your score? Edward, what do you think of this myth?
Yeah, it's well, remember they're just trying to, even though one would assume, I don't know why they didn't take that into consideration when making the credit score. I'm actually thinking out loud as I'm saying this, but I mean, it doesn't factor into the score at all. This would be something where like Patricia would be able to answer as far as the underwriting goes and the other decisions that are made in underwriting. They want to know what the income is. But as far as your credit score goes, it does not look at income because like you just said, people that make a lot of money can still be irresponsible and they cannot pay their bills and other things that can happen. And all they're trying to do is predict the chances of somebody becoming 90 days late or more. Now, common sense would tell me that somebody that makes a lot of money is probably going to be less at risk of going 90 days late than somebody that doesn't make a lot of money. But for whatever reason, they never decided to put that into the credit score formula. I think it is a predictive factor, but as of right now, it's not used in the credit score at all, even though I think it would probably make the score a better formula if they did take some type of consideration of income into it.
Okay, so like Patricia, what do you think then? So can it be a case where someone could be a millionaire, but they could have extremely bad credit?
Yeah, they actually do because they have the money. They're too busy spending, traveling, lots of businesses, and they forget to take care of their own personal finances. And we see a lot of it because in their mind, I'm making a lot of money. I really don't have time for this. And when they come in for a mortgage, we're trying to explain to them, this is important. Well, I make a lot of money. So what can you do about it? And so it, we do, like I said, unfortunately, we do see a lot of it. A lot of very wealthy people not paying their bills on time.
Okay. And so, for example, regardless of income, you could be a millionaire, you might be someone who, is on just an average income. What moves should they make or should anyone make then to keep up or rebuild their credit score then from here, regardless of their income?
I think it's important to pay your bills on time, which is rule number one. And especially if you have revolving credit lines. If you can pay your bills in full every month is great. Most people can't. But try to pay down as much as 8% or make sure your mix over all your credit cards is below, the rule of thumb is 30%. But actually it's a sliding scale based on the amount of utilization, and it ranges from 10 points to 40 points. And also, if the clients have one recent late payment, it can drop their scores as much as 70 points. Depends on where they're at on their credit score. So again, pay your bills on time. If you're maxed out, try to call your credit card company to see if they can increase your credit limit. If not, get your one installment loan, get some more credit cards. If all your credit cards are maxed out and you still can't reduce your payment, apply for a secured credit card. That one secured credit card will help to increase your credit score. What do you think, Edward?
No, I agree. Just a little side note. I don't know if do you have Discover card up there in Canada?
No.
Oh, okay. Well, yeah, as I say, Discover has a really good secured card now, so it doesn't have the stigma of like some bank that usually is a secured card bank that someone might not want to have on there. That is synonymous with bad credit people. But it's just no. I agree with you 100%. There's no magic formula to build credit. You have to get a few credit cards. You have to use them. You have to pay them off. Use them. Pay them off.
That's right.
Like I tell people, it's even good to keep when you're not applying for new credit, it's even good to keep a balance. Let the credit card company make a little bit of money off of you, so that way, and then pay it down to zero before asking for a credit line increase. So they made some money off you, so they know they can make money off of you, but then they also know that you're very whenever they pull a credit report on you to decide if they're going to give you an increase. Your credit score will be high because you paid it off before they pulled it. So that's the best advice I can give. Oh, and keep in mind, whenever you're going for a mortgage or a car loan or anything, if you are someone that pays your credit cards off, most credit card companies, they report your balance on the closing day of the statement. So if you're someone that pays your credit card off every month for like $5,000, whatever it may be, if you pay it off every month, whenever you receive the statement, you're still going to show that you owe $5,000 on the credit report for the next 30 days. So I say if your statement closes on the 25th of the month, call on the 21st, say, hey, or nowadays it's log into your app, obviously, and then just pay it down to zero before it closes. That way it closes close to zero.
Yeah, so following on just from what you said there, so the next bit actually was paying the minimum keeps my score up. So basically I'm new to credit cards, and I can put my hands up and say, yes, I felt basically that, if I paid the minimum, that's what I thought anyway, that I'm grand, that, my credit score won't go down. But thinking my credit score will stay level or even rise. I just want to know, is this correct? If I pay the minimum, will this work out for me?
Yeah, it does. But if you pay before the statement due date and the payment due date, at least that's 2 payments you're making that month, if you don't have the money to pay it off. And make sure that you use your credit card every month. If you go 6 months without using your credit cards, your card can become dormant. So I'll use it at least once within 6 months.
No, that's I agree with that 100%. You just have to use the cards you have, and you have to let the credit card company make a little bit of money when you're not applying for credit. But once it comes time to get a mortgage or a car, a month before that, if you can afford to, pay your credit cards to zero before the statement closes. That way, whenever they do pull your score for the mortgage or for the car, it's going to be as high as possible.
Yes.
Okay, and just a little side note then as well. So say, for example, I am paying my credit card off in full each month. Like say I'm only, I'm not using a lot every month, but I'm paying it off every month as opposed to just going into minimum payments. How will that affect the likes of interest? If I say, for example, I have a $5,000 credit limit, I spent $200, I only have $200 on it, but when it comes to my due date, I just pay the $200 off straight away. How would that work for me? Would that benefit interest, or would it benefit my credit score?
It depends. I think different credit card companies have different grace periods. I'm not sure how it works in Canada, but usually if you pay the balance off in full, you don't get charged any interest. And now keep in mind, the credit card company, they are making a little bit of money off of you every time you use the credit card. But as far as your credit score goes, it's definitely best to pay it off. But like Patricia and I were saying, but if you are doing a big purchase, you want to pay before the due date during the purchase, because you want to make sure it closes at close to zero. You know what I mean? That's if you can afford to, obviously. Another thing to keep in mind is if you can borrow money from a relative and say, hey, I'm getting a house next month. I have like 40 grand in credit card debt. My credit score is like a 680. If I can pay this credit card debt off, I can be a 730, whatever. I'm going to get a great rate on this house. I promise you, the second I get the house, I'll turn around and I'll take a cash advance and I'll pay you back. Now, I don't know what the questions are. You got to be careful. If the questions for mortgages are, what are your debt? Do you owe anybody? You shouldn't lie. But a lot mortgages down here in the States, they don't ask questions like that. It's like if a family member lends you the money, like they don't have a specific question. So you got to be just make sure you're not lying on the application, whatever you're doing. But
we'll find you.
Yeah, exactly.
Okay, yeah. So Patricia, just lastly, before we, I think we're just done. Just want to know, how would you recommend for anyone to pay off their minimum? I know you mentioned to me before about this. So, what is the best technique in order to pay your minimum on your credit card?
As we said earlier, try to pay a few days before the statement due date and a few days before the payment due date. I actually got a lot of clients. What I do with them to get them into the habit of it, to use their card every week, pay it off the following week, stagger it. And in that way, they're using it, they're paying it, you're showing activity on the card.
Okay.
And it allows them to pay down too, because if you're using something for gas for $5, you're paying $3, at least you're maintaining a lower balance at the end of the month. So you're paying 4 times a week.
Okay, yeah. Yeah, that's great. So I think that's it really. We've officially debunked the 4 most common credit score myths. I'm definitely enlightened to say the least, and I'm really excited to basically putting everything into practice. So lastly, I just want to say a huge thank you to Edward for joining us on today's show, and of course Patricia as always.
Thank you.
Thank you.
Thanks for listening today, and thanks guys for coming on the show. We hope everyone enjoyed it.
Yes, we did. Thank you.
Definitely.
Yeah. Thank you.
Take care now.
Thanks for listening, and we hope you enjoyed our very first episode of Bread and Honey. If there's any topics you'd like to see covered, let us know by connecting with us on Facebook, Twitter and Instagram. You can also find us simply by searching Marble Financial or using our handle @MyMarbleLife. If you enjoyed our show, don't forget to follow us on Spotify and Apple Music to make sure you don't miss our next show. You can also find this episode and all future ones on mymarble.ca/breadandhoney. If you're looking to begin your financial journey to empowerment and education, don't forget to register now at mymarble.ca. Thanks for listening.